On October 15, 1929, one of America's most respected economists, Irving Fisher of Yale, stood up in front of a room in New York and declared, "Stock prices have reached what looks like a permanently high plateau." He believed it completely. 2 weeks later, the market crashed, Black Thursday, then Black Monday, then Black Tuesday, and the Dow eventually lost 89% of its value. Fisher himself went broke. Never forget to like this video, subscribe to the channel, and turn on the bell notification so you never miss any of our future videos. The P/E ratio, or price-to-earnings ratio, is simply a company's stock price divided by how much profit it makes per share each year. If a stock trades at $20 and the company earns $2 per share annually, its P/E is 10, roughly. It would take 10 years of current profits to earn back what you paid. There's also a version of this same idea used for the entire stock market at once, called the Shiller P/E, or CAPE ratio. Instead of 1 year of profit, it uses the average profit over the past 10 years, smoothed out, which is exactly the number behind the hook you just heard. Fisher's permanently high plateau wasn't just wishful thinking, it was measurable. In the months before his speech, that market-wide P/E measurement, the Shiller P/E, had climbed to some of the highest levels ever recorded. The crash that followed sent the Dow down 89%, and anyone who'd invested at that 1929 peak didn't see a real, positive return again for over 25 years. Fast forward to December 1999, right before the dot-com bubble, and the exact same measurement hit a new record of 44, meaning investors were paying $44 for every $1 of the market's average yearly profit. The S&P 500 fell 49% over the next 2.5 years, and the tech-heavy Nasdaq fell closer to 80%, not fully recovering until 2015. 2 different centuries, 2 different generations of investors, and the same number flashing the same warning both times, right before 2 of the worst crashes in market history. Zoom into a single company during that same dot-com period, and you get an almost identical pattern. In March 2000, Cisco was the most valuable company on Earth, and its P/E ratio had climbed to 201, meaning investors were paying 201 times its yearly profit for the stock. The business itself didn't fail. Revenue kept growing every year after that. But the stock still lost almost 90% of its value within 2 years, and it took until December 2025, 25 years later, just to climb back to that same price. The market-wide warning from 1929 and 1999 showed up again, this time inside one single stock. A falling P/E isn't always bad news, though, sometimes it's the opposite. In 1963, American Express got caught up in the salad oil scandal, when a subsidiary made loans backed by vegetable oil tanks that turned out to be mostly filled with seawater. The stock price fell from around $65 to about $37 in a matter of weeks. Here's what mattered. American Express's actual business, travel, credit cards, checks, barely felt the impact. Profit stayed close to normal, so as the price collapsed, the P/E collapsed right along with it, for reasons that had nothing to do with the company's real earning power. A young Warren Buffett noticed the gap and put around 40% of his partnership's money into the stock. Over the next decade, it rose roughly tenfold. A shrinking P/E, in this case, was a business briefly on sale. Now here's the company I mentioned at the start. In its early years, Amazon barely made a profit. It lost money in 1996 and posted a $625 million loss in a single quarter in 2001. With no profit, there was effectively no meaningful P/E ratio to calculate at all. Even Warren Buffett, arguably the best value investor alive, later admitted Amazon always looked expensive to him, and that he simply didn't buy it. And yet an early $10,000 investment in Amazon's 1997 IPO grew into several $million within 20 years. Amazon was deliberately choosing to reinvest almost every dollar into warehouses and growth instead of showing a profit, which meant the P/E ratio had nothing useful to measure in the first place. 100 years of market history keep repeating the same pattern at the very top, when the P/E ratio, for one stock or the whole market, reaches extreme highs, in 1929, in 1999, or in Cisco's 2000 peak, the years that follow are usually painful. But a low or missing PE isn't automatically safe either, as American Express and Amazon both show in opposite ways. If you find this video helpful, do not forget to like the video, subscribe to the channel, and press the bell icon so you don't miss any future videos. Thanks for watching, and we will see you in the next video.